Yo, yo, yo! Welcome to the show where we break down complex financial stuff into something even your grandma can understand. We know finance can be a bit of a snooze fest, but not here. We make it fun, engaging, and super easy to grasp. Today we're talking about the CAT ratio, and no, it's not about ranking cat videos, though that would be awesome. Imagine if we could combine our love for cats with financial metrics. Now that would be something. CAT stands for Current Asset Turnover, and it's basically a measure of how efficiently your business is using its short-term assets to make money. It's like having a superpower that lets you see how well your business is performing. Think of it like this. You got your cash, your inventory, your stuff that you can quickly turn into cash. These are your short-term assets, and they are crucial for your business's day-to-day operations. The CAT ratio tells you how good you are at turning that stuff into cold, hard profit. It's a key indicator of your business's efficiency and effectiveness in managing its resources. It's like a magic trick, but instead of pulling a rabbit out of a hat, you're pulling profits out of your assets. Imagine being able to turn every dollar of your assets into multiple dollars of profit. Now that's some serious financial wizardry. The higher your CAT ratio, the better you are at this money-making magic show. So, keep an eye on that ratio and you'll be well on your way to financial success. Stay tuned for more tips and tricks to make your assets work harder for you. All right, let's get down to business. Today we're diving into the world of financial metrics, specifically the CAT ratio. Calculating the CAT ratio is easier than convincing your friend to split the bill evenly. Trust me, it's a straightforward process. You take your net sales, that's your total sales minus returns and discounts, and divide it by your average current assets. This gives you a clear picture of how efficiently your assets are generating sales. Imagine you're a food truck owner selling delicious tacos. Your business is booming and you want to understand how well you're using your assets. You made $100,000 in sales this year and your average current assets, cash, inventory of tortillas and carne asada, were $20,000. This includes everything you use to run your business day to day. Your CAT ratio would be 100,000 divided by 20,000, which equals 5. This simple calculation can provide valuable insights into your business performance. That means for every dollar of assets you had, you made $5 in sales. Not bad, amigo. This ratio helps you see how well you're turning your investments into profits, guiding you to make smarter business decisions. Now, what does this magical number actually mean? A high CAT ratio is like having a well-oiled machine. You're turning over your inventory quickly, collecting your receivables faster than a cheetah chasing its prey, and making the most of your cash. On the other hand, a low CAT ratio might mean your inventory is gathering dust like your grandma's antique collection, or your customers are slower at paying than a snail in a marathon. Section 4. The cat's out of the bag. Impacts of a high or low ratio. A healthy CAT ratio is crucial for a business. A high ratio means you're efficient and profitable. You can pay your bills on time, invest in new equipment, maybe even take that well-deserved vacation. But a low ratio? That's like a warning sign, like when your gas light starts blinking. It could mean trouble down the road, like difficulty getting loans or even going out of business. Section 5. Boosting your business mojo. Tips to improve your CAT ratio. In this section, we will explore some practical and effective strategies to enhance your current asset turnover ratio, which is crucial for maintaining a healthy and thriving business. So, how do you boost your CAT ratio and become a financial wizard? Here are some tips. These tips are designed to help you streamline your operations, improve your financial health, and ultimately, drive your business towards greater success. 1. Inventory management. Don't be afraid to say hasta la vista to slow-moving inventory. Regularly review your stock levels and identify items that are not selling well. By clearing out these items, you can free up valuable space and capital for more profitable products. 2. Speed up collections. Get that money, honey. Implement strategies to collect receivables faster. This could include offering early payment discounts, sending timely reminders, and following up diligently with overdue accounts. The quicker you can convert receivables into cash, the better your cash flow will be. 3. Cash is king. Manage your cash flow effectively. It's the lifeblood of your business. Keep a close eye on your cash inflows and outflows, and make sure you have enough liquidity to cover your short-term obligations. Consider using cash flow forecasting tools to help you plan ahead. and avoid any potential cash crunches. Remember, a healthy CAT ratio is like a well-tuned engine. It keeps your business running smoothly and efficiently. Regular maintenance and fine-tuning of your financial practices will ensure that your business remains robust and resilient in the face of challenges. So go forth and conquer the world of finance one taco at a time. Embrace these tips and watch your CAT ratio improve, leading to a more successful and sustainable business. Happy financial planning!